Hi everyone, this is Rohit Srivastava updating you on the 22nd of Feb 2015. We're just a week away from the annual budget. There are some interesting micro developments on the global side, so let me take you through all of that. But when it comes to the budget, I think that's the most interesting event for the markets. But over the years, what we've seen is that most policy decisions end up taking place outside of the budget, and the budget really ends up being a statement of accounts. But apart from that, it does give you some sense of direction. I think it's where the government really has the opportunity to tell you where exactly it intends to head. And one of the key issues I think that I would watch out for is to see whether they actually speak out on the fact that this is a government that's been voted strongly into power for some kind of change. And you really have to understand what is it that they've been voted in for. I think that's the big question that even they would have to look into. The markets would be very short-sighted. They always are. They're always expecting something from the budget that can boost it by 100 to 200 points in the coming days. But the way I try to look at it is not what would happen in the week ahead, but what would happen in the years ahead. And I think that's what often gets missed. And that's one of my fears, even when the July budget was announced, one of my fears was that there was so much hype created in the media that so much would be done that would drive the markets out of control. What I get scared with that is that then you're really missing out on the long term, because are you really setting the path right, or are you just trying to create near-term triggers for a bubble? So that's been my issue with budgets all along, especially when there's too much hype, because you can take a lot of short-term measures around taxes, which can make things better for you to invest. Doing away with STT and small minor changes like that, and the markets can get happy very much in the short term. But what you're really looking for is longer-term vision and direction in improving the business environment. To give you an example, I think India's roadmap to the reforms and change era really started way back in 91-92, and I started watching the markets somewhere in the early 90s. And at that time, we always looked forward to some kind of change taking place. And with the Manmohan Singh government and reforms when they were announced, I think we were all pepped up, especially as you are younger people. But the markets went out of control essentially on a lot of the short-term things which were there. Let me just highlight. That was the time when we announced for the first time delicensing. Now that should have really meant that you would have changed the business environment and the ease of doing business. That's really a big sign in terms of ease of doing business, because earlier you had to go for licenses every time to the government. But we still have licenses today, and we're still talking about the ease of doing business. Why is that? The reason is that we didn't really do the change at the deep in the system. We did something on the periphery, and definitely there were positives for the market. But what they did is they ended up creating a lot of near-term speculative bubbles. How did they do that? My sense, and this is my sense from how I saw it back then, and more as a student and watching the markets, tracking what was going on, trying to understand how things were headed. When you look back at it, essentially licenses are already given out to a large part of the big monopolies and corporates that were taking them over the years. Each time you are allowed to raise capacity from X to Y and Y to Z. And by that time you already had big economies of scale created in a couple of big industrialists that had already been there. So when they actually allowed everyone to come into the market, they also coupled it with financial sector reform. What they did is they did it with the CCI. Anyone could come to the capital market and raise a public issue for any investment and what that did is that a lot of people came in to set up capacities in various sectors, some of them genuinely so, and a lot of fly-by-night operations took place. A lot of IPOs came in where money just went out of the system. There was a huge underwriting scandal. So many companies raised money that were underwritten, where public was not investing once they realized that something was not right. But prices moved up, and then a lot of the underwritten shares were sold off. Now you would think that then all of that would really get caught into, I think, apart from the one biggest scandal which came out, which was the MS Shoes scandal that got investigated at that point of time. many others really did not come to the fore. And I was in the financial media then, and what came to me in my meetings with trying to meet up and speak to SEBI and various brokers is that essentially SEBI did not have the required powers. They were instituted only in 1992. They were just getting more and more powers from the government, and they couldn't really do as much as they would have wished. So the net result of that was that people actually lost interest in the markets because they were scammed and scandaled. A lot of public money was lost in either projects which could not compete with the big economies of scale that were already created by the larger houses in the preceding period. So we ended up with overcapacity in some sectors and a lot of new ventures that could not really take off. And on the other hand, you had all these fly-by-night operations where money simply got lost in the system. And nothing really got done. Investors that were investing almost 20% of savings into equity based on data back then has really never surpassed the 10% mark even till now. Even now, the last couple of years data is in like the lower single digits, 2%, 3%. And so if you really want to talk about change, you want people to get interested in investing, you want to change the way business gets done, you want to feel better about the quality of life that you have living in India. You want to stop brain drain. You don't want to see everyone going away, leaving the country all over again like they did in the 80s and 90s. Then I think what you're really looking forward to is something very different. If that's what you have in mind, if you're just looking for the government to announce something that can spur the market for under 200 or 300 points, then you're really looking just for quick monetary gains rather than building the long term. So that's really a very different kind of thinking that I have. So I would really like to see that kind of development. If something else is there that pushes up the market, fine, that's okay. But what you really hope for it to see some long-term direction to a better India. So that's and there was a very interesting interview today, I think, on Bloomberg, which I tweeted. Amitabh Bachchan was interviewing, and the discussion was essentially around climate change and similar issues. The choices that you make. I mean, we've just had coal auctions last week, and you want to fire up power. We need power for growth, but are we really thinking about the impact of all of this on the environment, and are we really working on the macro issues that the country faces rather than just solve the immediate problems? So I think this is an opportunity for long-term thinking, and I think that should be taken. So that's my view. But apart from that, looking at the markets, we have seen, apart from the big debate going around the GDP numbers that were released some time back on the new base, and everybody's confused because the real growth numbers that are coming out don't really match that. The ideal thing would be for them to stick to the older numbers till they can actually review the new ones and see that they match the underlying data. But even if they don't do that, the fact is that this year on the old series we would have actually grown more slower than the previous year, and we've been slowing growth over the last couple of years. Each year our growth rate is slower than the previous year, and this quarter for the first time I think we had negative growth in earnings. All of that said, the momentum in the market itself has been slowing since July, since the last budget, and all hopes are now eyed on the current budget. I thought even after the last one the markets would have realized that not to expect something out of the world, and the government has a bigger agenda to deliver to the people who voted them in, apart from what the financial markets might want. So they would have to address that at some point of time. They don't want to lose interest from the public at large, especially after the recent election. So I think somewhere that would have to get addressed, but at the same time it's pretty clear they're going to stick to the fiscal plans, and I think the big trigger therefore for the markets is really not going to be from the budget but from the day after, when sooner or later probably you'll get another rate cut right after the budget once we stick to the fiscal roadmap. So I think that's one potential trigger that lies ahead in the coming month. But apart from that, the markets have been trying to move higher but losing momentum at each stage, getting more and more fractured, fewer number of stocks participating at each point. Even of some of the big ones that have done well in the past and always risen to the highs, Even if you look at 2010 highs or 2008 highs, stocks like Reliance, Bajaj Auto often continue to go up till the last stages, and many of them have actually already given up. The key drivers remain the same: HDFC Bank, which are some of the biggest index contributors. But we still don't have a broad-based move in the market. All that said, if there are some near-term triggers announced, you can, and along with that interest rate cut, you can get a runaway. But if that's not there, then the current structure is more of an ending. Just like I wrote some time back on the mail, that many of these patterns look expanding or contracting ending patterns unless we break past the upper trend lines. The other interesting development which I was speaking about, the macro development, is that we've seen commodity prices in the dollar moving in opposite directions for almost more than 6 months. I think the dollar started a strong move way back in May, and commodity prices started selling off since July very sharply, especially since oil peaked in July. So we've seen almost each and every commodity, whether it's agro, gold, silver, base metals and precious metals, sell off. For some time I thought precious metals would bottom out some time back, but that hasn't happened and they're selling off again. So essentially in the last week or so we are seeing the restart of a selling cycle in the commodity space. You just can't see it in crude and copper yet, which is the most watched. But if you look at precious metals, gold, silver, and if you look at other base metals, lead, zinc, aluminium, all of them are starting to make lower tops and bottoms over the last week, selling off very, very clearly, giving an indication that the next leg down and probably the fifth wave, which would be the final leg for this cycle, should have started and should complete in the coming month or two. So what that means is that the next month or two we are getting this deep selling in commodity prices, and similarly in the dollar index, I think it looks like some kind of a fourth wave triangle, one more last leg up in the dollar. So one push up in the dollar, one push down in the commodities before we get a meaningful medium-term reversal, at least in these two, is on the cards, and that should be one pressure point. It's been a pressure point for some time. Whenever you see commodity prices fall, various markets which are associated with commodities appear to sell off, and many of them have seen counter trend moves. I think Russia, with its recent downgrade this weekend, should be the first one to take a hit. The other markets, of course, are Brazil, Canada, Australia, some of which have retraced. Australia has somehow been the strongest and gone back to one more new high despite the very big selling we saw in the previous quarter. However, those like Canada have just completed retracements and appear ready to move down again. So I think the commodity based markets again start to take a hit. India, of course, is not in that list, but it does come under pressure whenever there is a sell-off in emerging markets. So I think that is what we are beginning to see. So far we've also not been affected by the dollar, and the dollar rally continues to develop across various currencies that I'm watching, and my sense is that you just can't keep becoming stronger and stronger against so many currencies when everyone appears to be getting devalued. At some point of time you would get a knee-jerk reaction in our own currency markets as well. The surprise factor will really come in from all the unhedged positions, because I think most of the Indian exporters and a lot of people who are exposed to the currency markets actually are unhedged. We've not only taken on an increasing amount of money in the form of debt from foreign markets, which creates one source of risk. We've also had one of the highest inflows into our bond markets ever. I think in the history of FII flows, we've never seen so much percentage of that flow getting allocated to the debt side. So when you actually break it up, recent data that I was seeing essentially is that you're getting a smaller amount of flow into equities versus the previous year on a full year basis, even though the total flows are much bigger, because a lot of money is really gone into the Indian bond market. So I think a big risk comes in from that front, which is why my long-term view remains that the India's rate cycle is not turned, even though you may try some rate cuts in the short term, and that might appear to give you strength. Eventually, rate cuts are a stimulus to really weaken your currency, which is what we are seeing in so many other economies. We are not seeing that impact here as of now, but I think you will. We saw it even in 2013 when the former governor started to cut rates. Within 6 months, you saw pressure build up in the currency markets and eventually a sell-off. And a large part of that sell-off coincided with rising yields in the US bond market. So if you look at May 2013, that's when the third wave sell-off in the US bond market took place, and yields actually shot up from some 1.5% to 2.89%, and that's when our bond and currency markets came under pressure. And what we've not yet seen, despite the rally in the dollar, is we haven't seen US bonds sell off. However, the 10-year US bond completed a 60% retracement, and I think I can clearly see the first impulse down in the 30-year and 10-year US bond yields, US bond prices, which means I think there's a very high probability that US bonds have bottomed. They're already talking about raising rates sometime in the middle of this year. So the bond markets, I think, will start reflecting that much before. And if you see continued pressure in the US bond market in the coming month, I think that will become the first pressure point for our currency and bond market. So I think a lot of these risks, which have developed over a period of time, and we've not completely ignored them. We've seen a lot of corrections, but we see every time that the market bounces back, not on the back of any new growth story, but the same old stocks, which are essentially consumption and financials, and the auto sector, many of them exposed to the external environment, companies that are getting orders from outside, whether it's auto ancillaries or in capital goods like Larsen, or whether it's the IT stocks. A lot of them are essentially stories on the global growth cycle rather than the domestic cycle, and those continue to do well. But when the world markets do take a hit, then essentially we come under pressure again. And if you have bond and currency markets take a hit together, then I don't know how far we can really hold out against that. So those are the risks, I think, that we need to watch out in the coming month. But in the very short term, I think the key trigger would be not the budget, but the potential for the rate cut that would probably come in right after that, and the market would respond accordingly, depending on what the the sentiment on the world markets is. If there's not too much of a negative at that point of time, I think it would give us a positive stimulus. But apart from that, I don't see any other significant trigger right now. But then markets can be on their own. If they build the momentum for a speculative run, we'll have to capture that, and that would only be somewhere above the 91-50 level. As long as you're below that, I think the pattern will continue to look like an ending pattern across various indices, whether it's the Nifty, Sensex, mid cap, small cap. All indices have some kind of triangular ending development showing up, and so I'm going to be watching those levels and the breadth very closely for an indication as to what is going on. So that's all in this update, a pretty long one for this week, and into the budget. You can catch me next week on NDTV. I'll probably be there on Saturday on budget day at 8 a.m. And that's all from me right now. Thanks.